Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Kirk Spano, welcome back to the show.
How are you doing there, Brian?
Doing great. Excited about our conversation today. So we're going to talk a little bit about Fed tightening and specifically how Fed tightening is crushing the markets and how the economy is next, is how I believe you put it. Do you mind just kind of talking us through your thesis?
Right. So we've talked about the slow growth forever economy that I have been talking about since the Market Watch days 5-6 years ago. And the slow growth forever economy is the aging demographics of the four biggest economies, which are the United States, China, Europe, and then Japan. And all four of those economies are getting older, which means that they're slowing down on spending, right? Consumer spending goes down, and necessary items become a little bit more necessary. Healthcare becomes more expensive. And you have this deflationary force that is caused by demographics, which can't be solved in any short order because people are going to get older for years and years and years before they die. So we have this demographics curve across the four biggest economies that's really putting downward pressure on the global economy, and that's going to last for 20 or 30 years probably. So that's a permanent problem as far as most investors are concerned. At the same time, you have the deflationary forces of debt, that debt prevents investing, the whole crowding out impact that we all learned in Econ 102. And because 101 is micro, 102 is macro.
And debt prevents investing just because there's not money to invest. As simple as that, right? Yeah.
That's right, because people have to service their debt before they can invest new money. And then finally, technology is not really deflationary, but it's disinflationary. So it is another counterbalance to inflationary forces. And one of the articles that I have coming out is that deflation is the bogeyman or the boogeyman, depending on where you are in the country, not inflation. So that is the backdrop. And right now in the United States, everybody wants to talk about the trade war with China, and that's a big deal. But really the Federal Reserve tightening their balance sheet is what is hurting the stock market and the bond market, and soon they're going to hurt the economy. I talked about this in an article way back last February when I said that the Federal Reserve is making key mistakes. And they've continued to make their key mistakes. They have it in their head that they're supposed to normalize the balance sheet. Chairman Powell is a fool. I'll put that right on the air. He's a fool. He does not understand the economy. He doesn't understand.
He's probably listening right now.
Yeah. Well, I'll make sure I send this to him. So he doesn't understand the global economy. He's not an economist, right? He's a business guy who thinks that the micro world of a business is akin to the macro world of all the moving parts in the global economy. And that's the same problem that we're getting from the White House, frankly, because he's looking at the world in micro terms, which is why he wants bilateral agreements, and there's some argument for that. But we have these micro thinkers trying to deal in the macro world, and they're discounting the sociology, they're discounting the banking system, they're discounting all the diplomatic endeavors that have to be gone through, and they're just focusing on, well, I want a deal. And then you have the Fed over here that, because in the back of his head he's an Austrian economist, and you've heard me rail on the Austrians over and over again, the whole, oh, look, it's all fiat money, it's fiat money. Look, man, we're going to have fiat money forever because that is a representation of all the economic power that an economy has. So,
okay, let's pause real quick just to make sure that argument makes sense to everyone. Explain again. So what the fiat forever concern you're saying they have right there is basically that. Can you explain that briefly?
Right. So fiat currency, everybody says, well, the dollar is a fiat currency. Sure, every currency is a fiat currency. What does fiat mean? It means a representation thereof. And it is a representation, a fiat currency is a representation of the value of the underlying economy. And the reason why the dollar is the international currency, why we do all the trade in dollars, largely because of some of the deals we've cut, such as with Saudi Arabia for the petrodollar. But I'll tell you what, the petrodollar is going away in the next year or two, and that's going to be a big deal. But when it goes away, the dollar will still be the reserve currency. Do you know why? Because our underlying economy is better than anybody else's in the world because we're diversified, we have assets, we have commodities, we have a trained workforce, we have strong borders, even though a 3,500 person caravan somehow threatens us. And we have rule of law. We have property rights. We have the best geography in the world on top of all the other things that we've put together. So for all the bad things that the United States has done or made mistakes on, man, nobody can hold a candle to us. And anybody who says, well, look at Norway, look at them, look at somebody else. Look, I'll just jump right on Norway here just because, let's be entertaining. Norway, for all the little socialists running around who want to say how socialism has worked in Norway, this is how they made their money. All of their money is from oil. I thought you hated oil, little socialist. So, you have them making all their money from oil, and the sovereign wealth fund there used to be called the oil fund, right? So, socialism doesn't work, and whether we're socializing losses in the markets or gains in, to distributing them to just the 1%, or whether we're trying to create social programs, all these socialist ideas have the same flaws that Austrian economists have, and that's that they don't take into account that people want to live a better life, and the people who want to live the best life generally work the hardest. Some of them get lucky and come up with a great idea or wedge themselves between two piles of money, and they end up being the order taker, whatever. The reality is that capitalism is the best thing going out there, and this rant came from a little thing I had with a millennial a couple of weeks ago.
It sounds fresh.
You can read about it in my blog. I just ripped on the kid.
Well, let's do this because I want to be able to stay focused on what you're saying about Fed tightening, and so the point of that is the fiat is basically is Chairman Powell, in your opinion, his view of currency in terms of fiat, where is he wrong on that? His
flaw is that the Austrian economists believe that business cycles clean themselves out. Okay. And they're right about that. Okay? They're right about that part of it. What they're wrong about is that people can accept the depressions and deep recessions that come with that cleansing out. So for 100 years now, since the end of the Great Depression, we have taken the Keynesian approach, which is when you have a recession that's more than garden variety, or when you think you're going into a depression like what was about to happen in 2008, the government has to step in and the Federal Reserve has to step in and bail everything out and kind of do a reset. The problem that we've had with the Austrian approach and the Keynesian approach is that the Austrian approach encourages wealth inequality, and so does the Keynesian approach.
Okay, and just briefly, the Keynesian approach is basically says we're not going to let the business cycle correct itself. We're going to intervene and try to correct it.
We're not going to allow a lot of human suffering. Is basically what it comes down to. So it's like having cardiac arrest, and they use the paddles on you.
Gotcha. Yeah.
Right.
Which I guess, and I guess the general comeback some people would have to some of those is the fact that then without the Austrian approach, then the problem, the quote unquote problem, never gets solved because the Keynesian approach is like a Band-Aid that keeps masking the problem and kind of kicking the can down the road. I feel like that would be the typical.
No.
I'm not saying that's right. I'm saying that's
the person
comeback.
who doesn't understand it.
Okay.
Saying
But
that
that's a lot of
you're
people,
kicking it
then.
down. It is a lot of people, and they're all wrong, and that's why they suck at investing. So and I'm serious about that. I had a guy call me today and lecture me on libertarianism. Man, I own 3 businesses. I'm about as libertarian as somebody gets, right? But he's lecturing me on all these things and telling me how Keynesianism is wrong and kicking the can down the road. It's not kicking the can down the road. What happens to everybody on the planet?
Die.
That's right. We all are dead someday. So the idea that you can't keep doing that is wrong. Where we screw up is that when things are good, we spend a ton of money anyway. So when things are good, you're supposed to be balancing the budget and paying off debts. And when things are tough, you run up a little debt to get out of the hole. And the Keynesians in government don't really exist because they just spend money all the time. And when you take a look at the Republicans or the Democrats, both parties have spent a ton of money. And in fact, since 1981, during Republican Congresses, more debt has been run up than under Democrat Congresses. Oh my, right? So it has nothing to do with kicking the can down the road. It has to do with solving the problems. And we don't solve the problems because we wait for crisis.
So
the
the agreement there that the problem isn't being solved, but it's not because of fiscal policy or Fed intervention. Because my understanding, the Keynesian approach was saying, "Hey, we're not going to let a depression, recession happen. We're going to intervene to protect from that." Whereas the Austrians said, "Well, if this depression or recession doesn't happen, then problems won't get solved." And what you're saying is, well, neither one of them are right because neither one of those things actually solve the problem.
Real Keynesianism does solve the problem.
Okay,
we don't practice
because real Keynesianism would be you intervene in 2008. But then in the following years,
now you should be balancing the budget.
So right now, Powell, I guess, is maybe. So the problem right now isn't necessarily Powell; it's Congress not balancing budget.
Right. The Congress has done, and I'm not a big Trump guy, but he's done a handful of things right. I mean, you can't take it away. You can't say that everything he's done is wrong because when you throw that many things out, some of them are bound to be right. And so what has he done wrong? What has he done right? Who cares? And we're talking about the Fed. Right now, the Fed is doing something that they shouldn't be doing. And I said this a long time ago. They're pulling money off of their balance sheet because they just believe they should be doing it. Powell just believes they should be doing it. Why? Because he has this Austrian background, and he's not good at it. He's a bad Austrian. There's other Austrian economists out there that are a little bit better, but still fundamentally flawed. And again, because people aren't going to accept a depression, right? In theory, the Austrians are right, except when you take into account people don't want a depression. Right?
Sure.
So the solving for that is you spend your way out of it, and then you save up and pay off the debts when things are good. And the thing is we just don't pay off the debts, and they pile up and things get worse. Now, the Fed balance sheet ultimately is the perfect candidate for helicopter money, which is where you just drop trillions of dollars one time and you put it into assets that trickle into the economy. And during the deflationary period, that trickling in would offset the deflation so that you'd have your 1 or 2 or 3% inflation, which is what you're targeting to grow the economic pie so that we all can have improving standards of living. What they're doing right now at the Fed, as of October 1st and for November and December, is they are rolling off $50 billion a month in assets. So let's put that into context. $50 billion a year in a month in assets. What are the corporate buybacks this year? Going to be about $800 billion. So the Fed is basically almost completely offsetting the impact of the corporate buybacks, which have been propping up the market. Throw into on top of the deflation, you also have the Chinese have completely gotten rid of their buying of American equities, right? And real estate and big deals. So their investment in the United States in the last 18 months has dropped roughly 90%. That's a big deal. So the offsets to the deflationary forces of demographics, high debt, and the disinflationary forces of technology, which are all pretty accepted things. I mean, I'm not making that up. That's, economists on both sides of the fence acknowledge those things. Neil Kashkari is a Republican, Minneapolis Fed chief. He's right there, So, and then you got Larry Summers on the other side.
He's a nice guy.
Yeah. A lot of people from Texas. I've been meeting lots of. Yeah, I think you guys just have more babies down there or something.
Hey,
but
you know what? So question about the Fed rolling off $50 billion a month, because I think there's a lot of misunderstanding as far as what that means and why it matters. So by them rolling it off, that means there's what's actually going on there. What does that mean?
So during quantitative easing, the Fed rolled up $4 trillion of debt. That they pumped that money into the economy through the primary bankers, and that money went into bonds and then into equities, right? So they bought a bond, used the cash to get equities, and real estate and all sorts of other things. Well, now that they're pulling $50 billion a month out of the system, that's $50 billion a month that can't go into new investments.
So before they were by rolling up $4 trillion in debt, they were putting money into the economy by doing that.
Correct.
And now they're having to they're selling those things off their balance sheet. Is that right? Or
as those bonds come due.
Okay. Oh, as the bonds come due,
rather than getting new bonds, they're retiring them.
Gotcha. So okay.
So they're sucking that money out of the economy.
Yeah. So they're not pulling money out, they're just not adding new money back in. That's the biggest difference. And so,
no, they're sucking $50 billion a month out.
Right, but it's being sucked out because it's basically just expiring. Essentially, it's not like they're, yeah.
Well, somebody has to get a check for a bond that comes due.
Gotcha.
Right.
Okay. And so in this case, I own a bond. No, the Fed owns the bond, and
the Fed owns treasuries and mortgage-backed securities.
Right.
So rather than extending those debts to leave the money in the system, they're retiring those debts.
So Kirk Spano owns some treasuries, and no, they own the treasuries.
Fed owns the treasuries.
And so who owes them that money then?
Who owes?
See, this is where it gets confusing. I feel like I'm a moderately intelligent person, and it gets confusing to me. That's why I wanted to talk about it.
So the Fed receives the money,
right,
from the Treasury.
So
rather than buying a new bond,
okay,
and pushing that money to the primary banks, that $50 billion is just money that doesn't go back into the economy. It comes out of the economy to pay off the bond, rather than going back into the economy and just keeping the bond.
And so that's the dynamic. The dynamic is it's the Fed and the Treasury that this is happening between.
Right. So and the reality is that most of that money, when they were doing quantitative easing, found its way into the equity markets. So as that money went into the equity markets, the S&P 500 rallied. Right? And we have borderline third standard deviation valuations, and you can use any price to earnings ratio you want. You can use CAPE, you can use forward looking, you can use Buffett's what would it cost to replace the economy if you wrote a check.
Mm-hmm.
You can use any of those standards, and we're basically at third level standard deviation, and we've come down from the highs, obviously, with this correction.
And by saying third level standard deviation, that doesn't mean like 3 times valuation. Like, can you explain that real quick?
So a standard deviation is the range of normal, right? So if you're within 1 standard deviation, that's normal.
Right.
You go out to 2 standard deviations, that's abnormal.
Gotcha.
You go out to 3 standard deviations, that's holy crap, I'm scared.
Right. Well, and I'm glad we're talking about this, because one of the things I keep thinking about is in terms of cycles is we keep thinking, well, how overvalued are we? And you need to think back to the dot-com bubble. And it's like, well, we're not seeing valuations like that. And people think about FANG, how those have been really crowded trades, but those still, I mean, like Apple and some of those companies, like and Google, those valuations aren't crazy by any means. But I think that I guess the difference here is it's not necessarily one small class like tech was back in 2000. It's everything. Is that fair to say?
So real estate is as overvalued today versus income as it was in 2007. And that's a pretty big asset class.
Yes.
So because we've had very, very low wage increases, we're essentially in the same place on real estate as we were in 2007. The difference being is that we have all that extra money in the economy because of the ECB, because of the Fed, because of the Bank of Japan, all printing money. And as the Federal Reserve pulls money out, that's a problem. Well, next year, the ECB is scheduled to take money out. Now, the Japanese, in their wisdom, are smart enough to know, don't take any money out because the demographics haven't shaken out yet. And we really shouldn't be normalizing the balance sheet until the demographic curves are normalized. And so that either means we have to have billions more babies, or we have to wait for people to slowly die and for for 4 successive generations to be roughly the same size.
So the solution right now, in theory, would be, first of all, for government to stop its excess and balance a budget. That's the big thing. And not even just balance a budget, but start creating a surplus to start managing debt more wisely. That's the number one thing. But obviously, none of us can expect that to happen, unfortunately, based upon anything you're seeing. So that's a big issue. But ideally, that's what would happen, and that would help. That's what would really help. But the Fed, in the meantime, the Fed can't solve the problem, but they could help reduce the problem by maybe not adding new QE, but not unwinding QE. Is that fair?
Correct. They should not be unwinding QE. For certain, not more than they already are, which they're scheduled to go up again in January. I believe to $70 or $80 billion a month. I'd have to look it up. And if the ECB really starts to tighten next year, holy cow, right? Then you're in real big trouble. The reality is that demographics matter. Demographics are destiny. We heard Harry Dent talk about that. He was a bad stock picker, but his ideas about the economy and demographics are spot on. We know that because we've been able to back test it now. We need for there to be all of this money in the economy. And in fact, at some point, and I know people are talking about a debt jubilee someday, and the problem with that, obviously, is certain countries are just going to take advantage of other countries. But
and just to be fair, on debt jubilee, that means just a wide scale forgiveness of debt.
Yeah, and it wouldn't really be forgiveness of debt. I mean, helicopter money, in my opinion, is inevitable. At some point, the major economies are just going to print money. And they're either going to coordinate with each other so that nobody gets screwed too much, or they're not going to coordinate, and it's going to be a whole beggar thy neighbor sort of thing. And
just because, so helicopter money would be obviously that you hear those phrases back during QE and when money printing is the phrase you hear. And so basically you're saying helicopter money is kind of like a deeper level of that. And the point is, because of demographics, there's going to be nothing else to drive prices except for just flooding things with money. And the point of that would be like a Keynesian approach. Well, it prevents depression until demographics can get back to a place to restore a healthy economy. Is that
right? Okay. Right. And there's a right way and a wrong way to do helicopter money. Milton Friedman, again, pretty on the right.
Well, clearly helicopter money should come to seeking alpha contributors first. I mean, that's
right.
Obvious. Yeah.
Well, okay. But see, so right there, you're pointing out a pretty important problem is who gets the money, right? And when we did quantitative easing, we gave it to the banks. and that was a major screw job. Yeah, well, it was the wrong thing to do. We should have done it from the bottom up, not from the top down. And unfortunately, in this country, we do everything top down for the most part. We do trickle down economics, tax cuts to the rich, so that they can start, industry and whatnot. Which doesn't really work that way. We know that 85% of that money gets hoarded.
Of course.
So, what you really need to do is when it comes time to do helicopter money, and frankly, I think it's inevitable, because in about 10 years, all the baby boomers are on Medicare, and all the pensions are in withdrawal. That's one of the other things that are taking money out of the system right now, is that institutions for the last 2 or 3 years have been net sellers of stocks. Why is that? Because the institutions are dominated by pension funds. And now that the baby boomers have retired, there's more money coming out of pensions than going in. So they're selling securities. And so you got that. You've got the pensions selling securities. You got the baby boomers no longer investing. The millennial generation, the X generation, our generation. I don't know. You might be a millennial.
Nope.
Okay. So you're over 36. All right. So the X generation is small.
Mm-hmm.
Can't overcome the.
We're small but powerful.
Well, we'll see.
We're the Star Wars generation, man. Come on.
Yeah, well, right. If I have a lightsaber, I can do a lot. But and then the millennials are young, so they don't have a lot of money to invest. Mm-hmm. So there just isn't an offset for the baby boomers no longer investing. So you got the pensions pulling out, the boomers not investing. The Chinese left the market because they're mad at us, and now the Federal Reserve is sucking money out too. The only offset has been, because of all that QE getting into the banking system, eventually the corporation real profitable and they're back stock. But they can't buy back stock to offset all those four.
Well, so how about this? So if helicopter money is the solution,
really is
sorry, we get cut out there. Go ahead.
No, I would say the Fed has to stop shrinking their balance sheet, and that's what it boils down to. Can they shrink it a little bit? 10 billion or 20 billion a month, probably. Especially if the Chinese come back into the market, and I think that ultimately we're going to find out if that's going to happen. If we cut a deal with the Chinese, and they accept it and we accept it, then probably they start investing in America again, and they were the marginal buyer for several years. But without them, the Fed can't keep shrinking.
What about raising rates? Is that same thing, or they need to leave rates alone too, or rates can rise and that's not as big a deal?
They need to leave rates alone too. We're at the neutral rate. I mean, we're at a point where it was too cheap to get a mortgage for a few years. There's no doubt about that. But now, if you go and talk to real estate agents anywhere in the country, including Dallas, because I just talked to one down there,
it's slowing down here a lot.
Absolutely, it's slowing down there, and you guys have oil money.
That's right.
So
but
right, somebody in your neighborhood does.
Yeah, they do.
But the state economy generally is supported by oil money.
Sure.
And that's a whole different dynamic. Over the next 20 years, economies that were supported by oil money are going to have to look for different things.
That's our next podcast.
Right, and that's why Saudi Arabia is doing what they're doing, which, they're a bunch of jerks too, but you got to understand that they understand they have to diversify their economy, and they're going to do what's good for them. So in any case, if the Fed keeps tightening, and they actually start tightening more in January, even if they keep interest rates the same, for all of next year, which Paul Tudor Jones says they'll probably do, and Larry Kudlow was suggesting they might do, it's not going to matter if they keep tightening up their balance sheet and running those assets off, because that's pulling tens of billions of dollars out of the economy month after month, and there isn't an offset. Mm-hmm. The only offset is foreign direct investment, and we don't have it right now.
So basically, I guess, and just wrapping this up a little bit, is that if the Fed continues its current course and continues to shrink its balance sheet and raise rates, that basically the economy, the underlying economy, because of demographics, is not strong enough. And so that is one of the biggest drivers behind the market getting crushed right now. And if they continue doing that, it's not going to be just the market; it's going to be the economy as well. That's the basic theme.
Absolutely, and we know that the Fed overshoots and undershoots all the time.
Sure,
but because they're looking at the nominal numbers, it's the Fed funds rate is 2.25% or whatever it is. They're thinking, well, that's low historically, so we should raise it. No. You have to look at the current circumstances, and the current circumstances is that we have all these deflationary forces. Larry Kudlow even said that on television the other day, that inflation isn't the problem. We have all these deflationary forces. And I'll tell you what about Kudlow. Kudlow has been through the ringer in his career. He's been wrong about a bunch of things. He's been right about a lot of things. He's had his personal problems. But I'll tell you what, he's a smart guy, and he has accepted, and I've watched him do it on television for a decade. He has accepted that he had to adjust some of his views because the evidence made him do it. And he accepted that evidence rather than glomming onto ideology, which is clearly a problem all over the world.
Sure.
But he accepted the evidence. And people have to accept the evidence that deflation is real and that there has to be an offset. So one of the things that we could do is, if we really wanted to, we could do an infrastructure project, but we have to find a way of doing it without creating much more debt. So that money has to get recycled in such a way that we rebuild infrastructure, that there's all the wealth creation, right? The money multiplier, by having money go from the banks and the investors to the construction companies, right, to the telecom companies, and then to wages and then taxation, and you recycle the money. Capitalism works when we recycle money. Capitalism fails when we hoard and we spend more than we have for extremely long periods of time. So we need to get rid of the hoarding by recycling the money. They're really, an investment tax credit works just great. I don't know why they got rid of it. We gave all these tax breaks to corporations recently, and we didn't require anything of them. We should have said, hey, we'll cut your taxes down to next to nothing, which in theory actually makes sense if they're recycling the money. I'm not one of these guys that says, tax corporations to high hill. You actually want corporations with low taxes, low effective tax rates, because they're reinvesting money, right?
Yeah,
unfortunately, we know that, again, something like 80% of this last tax cut went to what two things?
Well,
dividends and buybacks.
Right.
They paid back a little bit of debt. They did a little bit of CapEx initially, but the money's going to buybacks and dividends, and the buybacks aren't even enough to keep their share prices up. So, you're about to create a much slower economy, and it's mainly the Fed, complicated by the problem with the Chinese right now.
Right. Hey, Kirk, awesome as always, man. Thanks so much for sharing your thoughts.
Anytime.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.